And today we are going to have some fun. I'm just going to let this room fill up a little bit. We are going to talk about whole life insurance versus term insurance, really cleaning up the conversation around that topic. I think there's a lot of people, obviously, in the infinite banking space, in the cash value life insurance space, that like to focus on the sexy parts of whole life insurance and all the different things that it can do for you. And I think, unfortunately, a lot of times we lose sight of the value of the actual insurance side of things. So in this video, what we're going to do today is go through and talk about whole life insurance. We're going to talk about term life insurance. We're going to figure out which one is the better fit for where, who is the better fit for term insurance, who is the better fit for whole life insurance, when is the best use case for each, the different problems that each one can solve. And it's going to be pretty comprehensive. If you break down what we're doing, I think this training overall is going to be pretty comprehensive. And my, as I do here, let's see if I could stay on topic, because I also want to keep the chat open. That's the nature of when I do lives. I've got my monitor right here that I'm looking at, and I'm trying to stay engaged as I possibly can with the chats of the people that are on live. And I always want to bring as much value to the people that are here live and be able to do a Q&A kind of element to everything for them. Whether you're an agent and you got questions on how to deal with things with your own clients, or whether you're somebody who is looking to make a decision in your own life about what to do for yourself. Sometimes it could be hard to give, obviously, personal advice with limited information. But if there's high enough level conversations, topics, then we can typically get into all of that, and we'll go from there. So I guess let's start with this. Whole life insurance versus term insurance. I think the first thing we need to start with is, how much insurance do you want? One of the things that I really lean on a lot when I have conversations with people about how much insurance they want to get, or they feel like they need, quote unquote, is as I tell them, well, in fact, you don't really need insurance. Insurance is very much a want-based decision. I look at insurance as, nobody really needs it, because especially on the life insurance side, nobody needs it. It's just a matter of, like, how much do you love your family at the end of the day? If I die, it's not me that needs it. It's my wife, and it's my kids, and it's my business partners. Those are the people that need me to have insurance. If I die, I'm not going to know anything after the fact. I mean, I guess it depends on what you believe. I may be looking down from above and watching my family and all that stuff, and energetically connected to it. And so the question is, like, what is that going to look like? But at the end of the day, it is very much a want-based product. And that's why I always say life insurance is the only way, when you properly design it and you have it properly integrated in with a financial strategy, it's the only tool that's going to allow you to make sure what you want to happen will happen when you want it to happen, whether you're here to see it or not. And that's where whole life comes into play. And so the first things first, let me just kind of go to my board here. What we're going to do is we're going to talk about the need for life insurance. So life insurance in general, and this is just in general. This has nothing to do with whole life or term. We're going to talk about how much do you need. Now, people ask me all the time, Chris, how much life insurance should I get? And the question is just, the answer to that question really varies based on what your personal situation is. But one of the things that I always tell people is that you are going to be able to qualify for 20 to 40x income, depending on what your income is, what your age, married, kids, business, assets, debts, etc. Right? So, like, that's kind of those are the variables that kind of come into play when we're talking about, like, how much life insurance should you have. My belief is take the max. If the life insurance company will underwrite you, I think one of the important keys to understand here is that you can never get wealthy through insurance. And what I mean by that is what the insurance company is going to do is they're going to say, all right, let's just start with this and let's just find a middle. We'll say 30x. Let's just say you make $100,000 a year. Okay. If you make $100,000 a year and let's say you're 40 years old, the life insurance company is going to say, well, all things said and done, this 40-year-old, if you have kids and you have a wife, between your debts and your liabilities and your assets and the fact that you have kids and all these things going on, let's just say they give you 30x up to 3 million. A lot of people go, well, heck, that's a lot of money. Well, what the life insurance company is doing is they're saying, well, how much money is it going to take for you to replace your income? If something happened to you, let's say you're like me, I'm 43 and I have a wife and 3 kids who will probably be barging through that door anytime now. They're about to get home from school. And so I have a wife and 3 kids. And so what I'm looking at is I go, all right, I've got 3 kids, 12, 9, and 5 years old. And I know I've got probably $600K in college that I'm on the hook for. I've got a mortgage, right? Future liabilities and debts that we have to take into consideration. And so you can look at a lot of that stuff and really bring it into the equation. But they're also looking at it from the perspective of saying, all right, if you were to save money during this whole period of time, how much money would you be able to retire? It's like, what is the replacement value of you look like? Like how do you replace your income? And so when we use the 4% rule, if we look at $3 million, 4% of $3 million equals 120,000. But remember, you're not using all $3 million to replace income. You're looking to replace your income, which would be the 100K here. You're looking to replace your income, plus you're looking to cover these expenditures, right? These future liabilities or whatever, expenditures that you plan on having. And so from that perspective, now we're looking at the fact that, all right, we need to maximize first what our desire for life insurance is. And so now what I look at from this perspective is I look at, what does cash flow look like? Too many people, I think, in this life insurance business, in the life insurance sales game, the agent space, they focus too much on the cash value side of things. And listen, I get it. I used to make the same mistake. It's exciting. I think it's the unique conversation. I think when you first get in this business, nobody really wants to be a life insurance agent. I mean, nobody grows up being like, what I want to be when I grow up? I want to be a life insurance agent. I think it takes life experience, and it takes certain things happening to you and certain levels of education and all these things to happen to really get you excited about the product when you realize the problems that it solves for people, and you have some experience with it and you see it in real life, and you see how it helps people close to you, or you see what happens to people that are close to you that don't have it. It starts to build your conviction. And for me, I know that to be true. And so when I look at that and I go, all right, when we look at the numbers, when we're looking at $100,000 of income, let's say we could get $3 million of insurance. Well, that's going to cover our $600K of college. It's going to cover our mortgage, and then it's going to replace our income. And using the 4% rule, that's what we're going to be able to do, because I want to make sure that my income is replaced if anything happens to me, that my wife and my kids get to keep living and keep functioning as if I were here, right? As if, like, financially, that I had never gone anywhere. And what this looks like here is, what we need to do is we need to first and foremost focus on cash flow. And so my belief, and I'm going to go back to the board, my belief is that if we don't think about, like, the biggest mistake is people go, oh, whole life or term. So you'll hear me say a lot, focus on structure, not product, right? And a lot of times I talk about that when I'm talking about investing or saving money, right? But the same premise exists when it comes to whole life versus term insurance. They each solve a different problem. and there's a little bit of an overlap. But at the end of the day, what we need to focus on first is cash flow. What does cash flow look like? And a lot of times, while people are attracted and they want the whole life conversation, cash flow is too low. They need to go out and improve their cash flow. Their greatest need in life is to create more cash flow, right? So what we need to do first and foremost is say, all right, what does cash flow look like? How much cash flow do you have? And let's just say if somebody has enough cash flow to save money, well, then we need to look at whole life is your safe money alternative. It's going to be like a savings account alternative or an emergency fund alternative, an opportunity fund account for you as you move forward that you can slowly build and save in. But ultimately, what we need to do first and foremost is take a look at the cash flow and say, how much term insurance are we going to be able to buy with the cash flow? If you have, let's just say you have, I don't know, $150 a month in free and clear cash flow, that's probably not going to get you that much unless you're really young. It's not going to get you a lot of term insurance. But what I would look to do is figure out how to go buy convertible term with this $150 a month. And if we look at some basic examples of term insurance, then you can see that that $150 a month probably isn't going to get us where we need to be, but it's going to get us to the point where, maybe it'll get us $2 million of term, right? Like something of that nature. Like I know right now, I just did a quote on myself the other day at 43 years old as a super preferred. It's $1,400 a year for $2 million more in term insurance, right? So just kind of give you the context there. At $1,400, that's less than $150 a month. And I'm able to pick up an additional $2 million in term to make sure that my family's protected, to make sure I lock in my insurability, and to make sure that when I want to convert it in the future, I have the ability to do so, right? And so now in this situation, though, that $150 wouldn't cover the full $3 million of insurance that the life insurance would be willing to cover in that 30x income, if that's the number, right? And so what we need to do is first and foremost to make sure that our human life value, our future net worth, because remember, what we want to do, the philosophy is buy your net worth, and build cash flow. Build cash flow. So what we're doing with that is we're saying, all right, if we're buying our net worth and we're building our cash flow, now what we're doing is we're saying, all right, as we build our cash flow, we will continue to buy more insurance until we have the $3 million of insurance covered. And once cash flow is good enough to go above and beyond that, we will start converting this over to a whole life policy, and we'll start building our savings account, emergency fund, right? And then as we do that, then we can go all the way to building an opportunity fund. And then we can go down to buying cash flow assets. It all takes a little time to develop, but at the end of the day, I think it's really, really clear. It's really clean. It's easy to understand. And I think it's very simple that we need to, as much as we love to start with a whole life conversation, as much as I'm a raving fan of whole life insurance, and I think at some point in time, every single person needs to have a whole life insurance policy in their life as part of the foundation of their personal finances, because of the fact that it will be permanent coverage. It's a way to backstop your wealth. It's a way to get into a place where you have your savings, your emergency fund. It's a way to build opportunity fund and ultimately go to building cash flow. That's why I wrote my book, Cash Flow Hacking, is because of the fact that, hey, if you can save money, but save with the intention of investing, now you're going to be in a situation where you can save, you can build the foundation, you can build yourself into a situation, a position where you can actually become an investor and not a speculator. So if you haven't already, I would go down to the link in the description below, go get a free copy of this. All I ask you to do is pay $8.95 for shipping and handling. You can go to Amazon and pay $20 or whatever it is for it. But if you just go to the cashflowhackingbook.com or click on the link in the description below, you can go check that out. I encourage everybody to do that. And ultimately, guys, that's when we look at like what kind of insurance should we have, this is what it comes down to, right? Like it's really that simple. We have to focus on cash flow because that's what life is all about. And unfortunately, people's greatest need is not necessarily, financial efficiency, even though that comes into it, or getting a better rate of return, even though we want to get the best rates of return that we possibly can. The biggest need is to create more cash flow. And sometimes that means we have to free up cash flow and we have to increase the efficiency in our life, and that's cool. But a lot of times it means we just need to create more. It just means we need to get more creative in how we're handling our personal finances. And unfortunately, we've been lied to, and we've been on this hamster wheel. We've been told we need to go to school, get a job, invest in our 401k, buy and hold assets, give up control of the results in our financial life, and hope that if we just store money away like a squirrel, stores nuts away preparing for winter, that if we do so for 35 or 40 years, at the end of that rainbow, we're going to hit 65 and be able to retire and manage our retirement properly. And the problem is that nothing could be further from the truth. If you look at the results in this world, 95% of people in the United States right now are reaching retirement and they're not able to maintain their standard of living when they retire. And, this is disgusting if that's the case when we live in the most prosperous country in the history of the world, and yet 95% of people are not able to maintain their standard of living when they retire. And so the question then becomes, what do we do about it? And my answer is invest for cash flow. If you focus on building a system that first and foremost locks in your family, and you get this $3 million of coverage in this situation, and now what's happened is you've bought your net worth. If anything tragic happens to you, you've now instantly created a legacy. You've created a self-completing mechanism that says, here's what I want to do in my life. This is what I'm trying to accomplish. If I live a long, happy, healthy, fruitful, productive life, I plan on creating a legacy of at least $3 million. And you know what? The life insurance company, that's why they're willing to give it to you, because they say, you know what? If you live a long, healthy, happy, fruitful, productive life, and you're making $100,000 a year, and you do all the right things, and you manage your money properly, this should be about your net worth at the end of that, after all your obligations, at the end of all these things, at the end of all your debts. They're going to give that to you because they know that that's it. Now, what you're doing when you buy term insurance is you're renting that result. You are renting a $3 million net worth purchase result, because what's happening is they're saying, all right, we're going to give it to you, but we're not, that risk, if you don't understand the risk, 99.1% of all term insurance policies never pay out, right? That doesn't mean they're not good. It doesn't mean you shouldn't have it, because once again, because they never pay out, the cost is absolutely going to be lower. And so once again, if anything happens to you in that period of time, then you're going to be protected. Your family is going to be protected. And that's a self-completing mechanism. But you're renting it. So what you need to do is you need to rent that $3 million with the goal of, you have the option to buy. If you've ever done anything in real estate, you maybe have heard of the term a lease option, right? So you rent a house with the option to buy. That's what convertible term is. You're renting your life insurance. You're renting the death benefit. You're renting your net worth and the future capacity from a legacy play. You're renting that, and you have the option to buy when you decide. And when your cash flow gets to the point, when you built your cash flow, and that cash flow is to the point where you can actually do it, that's what it's about. And then as that happens, now you can convert, say 10% chunks every single year or whatever. If you got a 3 million, what I would suggest for anybody is to do like a 15-year term and give yourself 15 years to convert it. And if you focus systematically on converting it, you can take a percentage of that. Let's say 10%, give it 2 or 3 years to get the foundation built up, and then do 10% a year on that $3 million to convert every single year. And now before you know it, you're going to have a system that is designed, and that you go from renting your net worth to building your net worth. Then you build your emergency fund. You're all set up to go. You build an opportunity fund. You start to invest in cash flow. And by the end of that 15 years, you will be financially free. You don't even have to. And and I talk about how to do this in my book, right? Like how you can literally reach financial freedom, right? The playbook to reach freedom, financial freedom 4 times faster, regardless of your age, income, and where you're starting right now, right? So if you think about it through those terms, like I just like really think about that. 4 times faster than a traditional retirement plan. A traditional retirement plan is 40 years. We've all been duped to believe that we got to go to school, get a job, invest in a 401k, invest in an IRA, give up control of the results in our life, work 40 years, get on the hamster wheel, live somebody else's dream, work somebody else's plan, and then hopefully if we do it, we'll be where we want to go. But the reality is you can do so much faster. You can be in control of the results in your life. And this is unfortunately what the system doesn't want you to know. I truly believe the financial system is designed for us to kind of keep running on it like hamster wheels. Garrett Gunderson says it the best that I've ever heard it is that Wall Street is not a value creation machine. It's a value extraction machine. The people that get rich by investing in Wall Street, the mutual funds, stuff of that nature, are the people that are the fund managers. That it is Wall Street themselves. It is designed kind of like a stock market, kind of like a casino, where the casino, you put money in a slot machine, it'll give you money back. Some people go in, they'll win, they'll hit it. And I equate the 80s and 90s kind of like to the casino, to the person that goes into the casino and they put their money in a slot machine and they hit it big and they go, whoa. And all of a sudden they have a gambling addict, right? Like the person becomes a gambling addict because they go, wow, look at the results. I went into the casino. First couple times I ever went, I won both times. Well, guess what? That was the 80s and 90s. I did a video that came out a couple days ago. I was talking about the history of the markets, right? And how every financial advisor out there is taught just buy and hold, and to teach their clients to buy and hold. And if you do, you're going to average 8% over the long term. And if you do that, you're going to be good to go. The challenge is actually, you know what? I'm going to see if I can pull that up right now, because I think that'll be fun to have a conversation around. Let me go into this. And if anybody has any questions as I'm going through this, once again, please feel free, hop in. I love the Q&A. I love the dynamic element of everything. I love being able to just engage with people on a kind of live basis, right? So I did this in a live video the other day, but let's look at this. Let me actually let me share my screen here. Entire screen. Okay. All right. So what I did here is, this is the stock market, right? So this is talking about the misleading elements of average, the concept of average versus actual return, and what it is in the market, showing from 1929 all the way to 2022. So what happens is, if we look at, like, I'm a big believer in asking, why do people believe what they believe? And if you understand anything about the financial advisors right now, remember, most of these financial planners today, back in the 80s, used to be what's called stockbrokers, right? Like, so if you know what a stockbroker is, it's somebody who sells stocks. They're a broker, i.e. they're a salesperson. They're an intermediary that is designed to help you fulfill a transaction to buy a specific asset, right? And so they're licensed to be able to pull off these transactions. And over the years, the industry has changed to make it so they were deemed financial advisors, okay? And so when we look at this is what I look at here. From 1929, I broke it up because, okay, the left bar here, actually, the left bar here, you can see right here, that left bar basically shows long-term average is 7.1%. That does not include dividends. So you would throw the dividends in there and like whatever on top of that if you reinvested the dividends. But it shows that the average would be 7.1%. Okay, that's fair. The challenge is, if you look at here, I'm sorry, I'm bouncing all over here. If you go over here to right here, this area that I'm highlighting, okay, that's 1980 to 1999. Okay, so if you pull that out, and that's 1149 to start. So we got from 1980 to 1999 an average of 15.4% rate of return. Now, what I want to do here is go up here. I'm going to copy and paste. I'm going to copy and paste this all the way through 1979. I haven't done this. I was going to do this the other day. Copy. And so I'm going to go way over here now. I'm going to bring it way to the top, and I'm going to add it in. I want to keep all the statistics the same. So keep bearing with me here. I'm just doing this live, so it's going to be a little clunky, whatever. But I think it's going to be cool to see. And then I'm going to go from 2000 to 2022. I want to see what the result is actually going to be. So then I'm going to go up. And we're going to skip over 1980 to 1999, and we're going to jump right there. So we're removing this window of time out of the equation where the average rate of return is 15.4%. Because when we think about, I'm a big believer of asking, why do we need to do anything, right? Why do we want to do anything? Why do people say that doing this with your money is the way to do it? And I just am a big believer that we need to dig deeper and ask why. And when I look at and I think, why do people do it? It was because, if you understand anything, 401ks became mainstream in 1980. And if you understand the fact that when 401ks were created, IRAs were made popular, qualified plans, we went away from a defined pension system to a defined contribution system in that point in time, and it started to ramp up. And so then you looked at also the fact that 1980, we had record high interest rates, and then we had a decreasing interest rate environment for the next 20 years. And that, if you understand how a decreasing interest rate environment functions in the economy, what that does is it elevates the prices of assets. So the combination of the fact that people were flooding into the markets and the fact that interest rates were reducing, driving up the price of performance of the market, not to mention that inflation during these years were higher. So even though the returns were higher, the inflation was also much higher. Like in 1980, inflation was double digits, right? So even though it's a 14.93%, that's not the real return on an inflation adjusted average, right? Or basis. And so there's more to the conversation than the actual impact on your lifestyle. And it's really easy to make numbers look sexy on a spreadsheet, but life doesn't exist on a spreadsheet. Sometimes we have to look at things a little bit differently. And so what I do here is I look at this and I go, all right, we got how many columns down here am I? I'm at 75 minus 2, so 73 years. So the sum, so I'm going to go equals sum. Yeah. Okay, divided by 73, and that's a 4.9% average. Okay, let me percentage that. Okay, so what I did was, in case you couldn't see, we had 73 years. So what I did is I took this 75. We're on column 75. It started on column 2 here. So I did 75 minus 2. So we're 73 years. And that's an average of 4.92%. So outside of this 15.4% 2-decade period, the stock market has averaged 4.92%. That's it, right? So yet somehow we've gotten duped into believing that because of the results during this period of time, which quite frankly were an environment that will never exist, that those variables will never come into play again unless we see interest rates hit 20%, which, by the way, if we see that, we're going to have economic calamity in the process. And the fact that we had, for the first time in history, everybody in Main Street became an investor in Wall Street because of the defined contribution plan that enhanced or encouraged, I should say, people to invest in stocks, in mutual funds, and 401ks, and the vehicles inside of 401ks, right? And so I think that's really important to understand that process on why. Everybody understand that? Hopefully, if you have any questions, go ahead and comment in the comment section. I'm happy to go deeper. I'm happy to do whatever I got to do as far as giving clarity behind that. But when people really push back at me, the thing that fires me up the most is people that say you should buy term and invest the difference because it just is what it is. Like they just think that that's the way to create wealth. But the reality is, if you look at the results of the stock market from a long-term perspective and you compare it to a whole life policy, if you're saving, I first of all, I don't believe looking at a whole life insurance policy and comparing it to an investment is a fair conversation, because it's not an apples to apples thing. Whole life insurance is not an investment alternative, it's a savings alternative, right? So if you want to say buy term and invest the difference, it's not the conversation. It's should you buy term and save the difference, right? And now when you talk about a function of saving, now you have to compare it to not investments. You got to compare it to what are bonds going to perform at. You got to compare it to what are CDs going to perform at, or what are like your savings account going to perform at from a long-term basis. A lot of people like to look short-term and look at the savings rates right now in the rates of return inside of high yield savings accounts at this very moment in time at 4.5%. And they're like, oh, why would you ever put your money in a whole life policy? It's crazy. And so, and I say, well, yeah, sure. Right now, if you look in a vacuum, then high yield savings accounts are great right now. But I got news for you. If high yield savings accounts keep going up, that means the fixed market's going to keep going up. And if fixed market keeps going up, that means dividend rates and whole life insurance are going to go up as well. Since 2000 what, Chuck? I'm curious what you mean by since 2000. But so when we look at this and we look at the numbers and we look outside of that one vacuum, that one window, that one period of time from 1980 to 1999, whole life insurance actually competes really well with an investment, especially when you look at the fact that it's got a tax favorable basis that you can borrow against it tax free. Because remember, if you put your money in a 401k and it's not, and you're only getting 4.92%, as it says on the board right there, now you got to take that as earned income. And so that you're going to be paying 20% taxes on it, right? Earned income tax. If you have your money in a whole life policy, you're probably going to get close to 4.92% long-term as well. But you're going to be able to access it tax-free. Now, the one thing I always tell people is whole life insurance companies do one thing better than any other financial institutions in the world, and that is they get you the best rate of return possible, with the variable taking into consideration that they're going to get you the best return possible with the least amount of risk possible. And so when you throw that variable of the least amount of risk into the equation, it's obviously going to reduce the potential upside. Oh. So what the markets have done since 2000, let's go down and look at that. I guess I didn't get there, did I? Thank you for bringing that up, and thank you for bringing me back full circle, and as I have a habit of getting distracted. So since 2000, they've averaged 5.81%, right? And so, it's a shorter window of time. We got, so from 2000 to now, 5.81% on average, 80 to 99, 15.4, and from 29 to 79, 4.51%. Those are the numbers, okay? So 4.51% for 50 years, right? Which I don't think anybody's going to be looking at that getting super excited, right? And if you look at that and you also compare that to the actual rates of inflation, it's even worse, because the inflation rates in the 70s actually made it so that 4.51% average made it so you basically broke even from a purchasing power perspective on any investment that you had during that time, right? So 4.51% isn't going to get anybody excited. Obviously, the 15.4 from 1980 to 1999, that's super sexy, right? That's super appealing and attractive, right? So when we look at that 15.4% is fantastic. But then when we get down here to the 5.81% from 2000 to 2022, once again, not attractive. But one of the things that I think is really important to understand is that if we are, how to say this? Well, the way I put it is this: I'm 43 years old. My parents, I was born, I should say, in 1980. So my parents had their working careers. This is when they were working. This is when they were creating their wealth. This is when they were starting their plan for retirement. This is when, they built their beliefs around what is the right thing to do, right? This is what they did. And so when I look at that and I go, okay, it makes sense, that if in 1980, by the way, the top marginal tax rate was 70%, which is crazy to think about, right? Because now it's under 40%. So at 70% back then. So if you could take money and put it into a defined contribution plan like a 401k and you had the ability to defer taxes at 70% and take taxes today at 40%, and ride this market up, well, that seems really appealing. And guess what? For everybody who did it at that point in time, they won. It was a good deal. It worked, right? But the problem is now things have changed, and what worked for our parents, what worked for the previous generations, guess what? What worked for our parents here didn't work for our grandparents right here. Look at these results. If they had been following that advice, they would have failed horribly, abysmally, right? And so it didn't work for them. It happened to work for our parents completely because of the environmental scenario that we were in, as I said, with high interest rates going to low interest rates, and the fact that they were able to borrow against or defer at higher tax rates, only to pay now when taxes are half what they were. And the fact that the market got a big boost in the 80s, the booming 80s, was in large part due to the fact that everybody who is a Main Street person who is not invested in the markets, now 401ks and qualified plans put everybody in the market. So supply and demand just drove the prices of those assets up. And so it was kind of a perfect storm that led to massive growth. The bubble popped, the dot-com bubble happened. I think we all know that. And then we had 9/11 that came up. We had another crisis in 2008. We had COVID, which wasn't even a negative year at the end of the day. And then 2022, things started coming around. 2023 is, yet to be determined. It's a little bit better than last year, but I think a lot of people are really, really worried about 2024. And I think everybody realizes that, the next 30 years are not going to look like the last 30 years. Like what worked for our parents isn't going to work for us. And it's probably not going to work for our kids either. And so we need to be nimble. We need to stop being so stuck on a way of doing things. And one of the reasons I love investing for cash flow, one of the reasons I love having this conversation about, all right, what kind of insurance should we have? Because that's a foundational component to our financial plan and strategy, because I believe we have a responsibility to take care of the people that we love. I believe we have a responsibility to leave our kids and family and communities better off than what we inherited. And I wish everybody would just focus on taking care of their family core structure, taking care of their communities before worrying about the rest of the world. Because I think if everybody did that, the rest of the world would end up taking care of itself intrinsically. The world would just become a better place because people were just taking care of their own responsibilities. That's just me. Maybe I'm idealistic. But that said, I look at it and I say, all right, if we can do this, if we can take control of these things, then we can save, and then we can, be willing to go slow on the front end, build our foundation, which is harder, which takes a little more time and a little more dedication. But through that process, you're going to learn more. You're going to become more competent. You're going to become more confident. And then you're going to be able to go invest for cash flow. And rather than give up control and put your money in a system and outsource the success to some other person that doesn't have the same vested interest in your success financially, like a financial advisor, financial salesperson, you take control of it, and you go and you invest in cash flowing assets. That gives you protection against inflation. It allows you to build your cash flow. It allows you to connect subconsciously with what you're trying to accomplish. And what I mean by that is actually, I'll tell you what I mean by that. I think it's really important. So subconscious, if anybody's ever heard me, I've done videos on this before, the ant and the elephant, the power of the subconscious mind is basically saying the human brain is only going to allow you to put 100% of effort into something you believe with 100% certainty you'll be successful with. So what does that mean? That means if you make $100,000 right now, and we use the 4% rule. So what that means is people look at it and they go, all right, 4%, 100,000. What do we need to do? That means I need 2,500,000 in an account to be able to have 4% create $100,000 a year of income. So that's what most people look at. And they go, all right, with the 4% rule, I need $2.5 million. So if you're making $1 million right now, I think a lot of people even have a hard time believing that you're going to get to $2.5 million to be able to get there. And this is one of the reasons people struggle. But the problem is it's worse than that. We actually have inflation. So at worst case scenario, if you look at 4% inflation, which is, long-term, since 1971, we've been at 4%. It's like 4.4% inflation. So let's just go to 4% inflation over a long period of time, over a 40-year period. and we look at 4% inflation, if we go the rule of 72 divided by 4 equals, well, I don't know, 72 divided by 4. My math hat is not working right now, so I will just go to the old calculator. I should be able to do this in my head. It's kind of embarrassing, actually. 72 divided by 4. I just want to get it right. So it's 18 years. So every 18 years, the money doubles. So what does that mean? That it means if you have a full working year and you have 36 years of a career, which is pretty close to average. So let's just work with that number. That means 18 years from now, that 100,000 is going to be 200,000, and that's not a better lifestyle. That's looking at it to maintain that standard of living. That 200,000, 18 years from now, 18 years later, is the equivalent of $100,000 in purchasing power today. And then 18 years later, it's going to be $400,000. So the crazy part with 4% inflation, what that does is it tells you that $100,000 36 years later will need to be $400,000 just to maintain your standard of living. That's not even getting ahead. And so now when we look at 4% of $400,000, how much do you need? You need 10 million. I don't know a person alive making $100,000 right now that believes with any confidence that they're going to get to $10 million of retirement income, right? And this is the problem. People are not measuring and focusing on the right metrics that actually are going to have an impact on them getting to where they want to go when it comes to their money. Whereas if we said, hey, listen, I understand that life is going to get harder, that inflation is going to go up as I go through life. But rather than trying to focus on this number and trying to get to this, because the human brain is not going to align, you're not going to be able to trick yourself into believing that you're going to get to $10 million of retirement income, making the income that you're making now. Because you know why? Because you've never held $10 million in your hand. You've never seen $10 million in your bank account. You've never experienced that. So subconsciously, it just feels out of your reach. Whether you believe it or not, no matter how much you talk about it, that's what the ant and the elephant is all about. Is like when we make a conscious decision to do something, whether it's lose weight, whether it's save money, get out of debt, or do anything of that nature, we are making a conscious decision, and that our brains are firing off at 4 million neurons a second to be able to do that. So when our brains are firing off at 4 million neurons a second to make these decisions and kind of and show determination and self-discipline and will and all these things to go do what we need to do, when our subconscious is firing off, it's going off at 4 billion neurons a second. So the thinking we can just grit our way through this and just be disciplined to get there without programming our subconscious to be actually believe what we're doing, which going for 10 million when you never experienced it, good luck. The amount of work you're going to need to actually program yourself subconsciously is going to be astounding, right? So it's the equivalent, though, of doing that is the equivalent of an ant sitting on the head of an elephant thinking it has the ability to steer that elephant. And I think that's a key point to understand. So what we need to do here, though, is instead, and this is what, by the way, this is what I talk about. That's what this book is all about. If you haven't got this book, I encourage everybody to get a copy of it. Go to cashflowhackingbook.com. You can go down in the link in the description below. It is down there. It's free. All you have to do is pay for shipping and handling, or you can go to Amazon and pay $20 for it if you don't want to give me your information. Either way, good by me, but I think everybody should get a copy of that and read it and check it out. But here's the deal. If we just then say, you know what, I'm not playing this game because I'm not going to be able to trick my self-conscious or subconscious into this, right? What I'm going to do is I'm going to create a cash flow plan. What I'm going to do first and foremost is to make sure that I'm a good human being, that I take care of my family. So I'm going to make sure I maximize term insurance. Whatever I can then, I'm going to try to make sure it's convertible term. And then what I'm going to do is I'm going to save money before investing, but I'm going to save money with the intent of investing, right? So as I save money, the goal is to save money but not take on risk, not go out and take on unnecessary risk. I will answer that question Isai, in a couple of minutes. Let me finish this and I'll come back to your question. So one of the things that I think is really important is that as you're saving money, your goal is to save money with the intent of investing, and you're building your emergency fund. And the goal is to have that emergency grow to the level where it can become an opportunity fund. And an opportunity fund is where you look for cash flow producing assets. So when you have enough, then you go buy cash flow assets. Now, what we're doing here, let's use the $100,000 of income as an example, right? So what we have is we know that monthly we have $8,333 a month of cash flow. That's what we have. That is our income. So this is the thing, and this is the power of the subconscious mind, and this is why I love investing for cash flow. It's not just the fact that financially it's more efficient, right? It's not just the fact that it's going to help you get to retirement 4 times faster. It's the fact that you're actually going to believe in your ability to do it, because you've never done this $10 million thing, right? You've never done this 10 million and seen 10 million. So your brain is going to just totally short wire and trip out. But this 8,333 number, you know it. That's what you see every single month. You've seen that money go through. Hey, Brandon, what's happening, man? You've never seen that $10 million, but you've seen this $8,333 come through your life time and time again every single month. So you believe in it. So now what happens is you go buy your first cash flowing asset. And let's say it provides $400 per month for free and clear, and you have that $400 a month. Then you're going to save that up, and then you're going to reinvest it, and then you get another $400 a month. Maybe a year or two later, now you're at $800 a month, right? $800 a month. What this is doing now you have 10% of this number pretty much covered in 2 years. And if you compound your cash flow and you don't spend it and you don't increase your lifestyle and all this stuff, what you're doing is you're building this. And before you know it, 10 years from now, this number is going to be covered and you're going to have $8,333 per month right there. Now, here's the deal. 10 years from now, this $8,333 because of inflation is probably going to be more near $10,000. And as it grows, the cool thing is if you invest the right way, you're going to be investing in assets that are going to protect you with inflation. So the incomes will grow the same way on a ratio basis that your income would grow over here. And so that provides an inflation hedge, and it becomes kind of a no-brainer when you look into it and when you realize the power and the flexibility that investing in cash flow provides you. And it puts you at the center of your own success. And to me, I think we're all responsibility to take that on. I mean, that's why I talk about the 5 F's of life: the faith, family, fitness, finances, and freedom. Everybody wants to get to freedom. We all know that we can't outsource our success with our faith. We gotta be in our own faith. We gotta, whatever you believe spiritually, that's between you and God. That's between you and your higher power, right? And whatever that looks like, you have to take that responsibility on. My pastor can't pray for me. I mean, he prays for me, but he can't do my reading and the hard work and handle my relationship with God for me, right? Only I can get my heart right with that. Only I can do that work. My family, I can't outsource the success as a husband, as a father. If I do, I promise you my marriage and my relationship is going to have problems, right? With my fitness, my health, I can't, nobody else is going to eat right for me or do my push-ups or work out or any of that nature. I think we all know that. And I truly believe that there's no real freedom in life without freedom with your faith and being really comfortable with that, without freedom and great relationships in your marriage and your family and your friendships, right? Without freedom in your health. I mean, let's face it, how many people get to retirement and they feel financially free, but their health is a total mess, right? That's not free. And the way I look at it is, freedom has to encompass all of them, and financial freedom is just an amplifier. It's the fuel on the fire that if you do it the right way and if you manage and take control of it, it's gonna amplify and accelerate the results in every other area of your life. If you get your relationship with money down, and if you get to understand how to manage it and deal with it effectively, it's going to change everything for you. And I just believe, I don't understand how people have been duped into believing that you're too stupid to take responsibility and for your own money, thinking that you have to give up control and give it to some stupid financial salesperson. I love it, man. Love it. That's awesome, Brandon. So all right. So somebody asked me, all right, let me get to a question here. All right. What are some of the things I should look at to make sure a whole life policy is properly structured? My Northwestern Mutual advisor structured a front-loaded policy with 100K and then 10 to 15K per year. Okay, that's cool. If you did that, I'm not sure how long you are required to make premium payments on the Northwestern Mutual policy. I'm not going to sit here and say Northwestern's a bad company. I'm not a fan of them personally because I just don't think from an asset perspective, Northwestern Mutual is the best. They're a direct recognition company. I prefer working with non-direct recognition companies, meaning a direct recognition company basically says when you take a policy loan, it's going to reduce the performance of your dividend for the amount of money that you took a policy loan against that policy. So if you had, here, I'll go to the board and I'll show it. Here we go. So what we do here with a direct recognition policy is like, all right, if you had $100,000 of cash value, right? And then you took a policy loan of 50,000. Then what's going to have to happen is the net cash value is going to be 50,000. So what will happen is you'll have a net cash value of 50,000. You'll have a policy loan of 50,000, and the dividend on the net cash value might be whatever their current dividend rate is, 6%. But then the dividend on the cash value for the 50,000 that you have loaned out might be dropped to 4% or something like that. And that's what companies that are direct recognition companies do. I'm not a big fan of that. And so that's why I like to work with non-direct recognition companies more, because it's just the transparency behind how the policy loans work and it's less moving parts. The fact that they're able to do 100,000 front load and then 10 to 15K per year. That's cool. Not everybody will do that. And I'll say this on your Northwestern Mutual agent, like good for them. Not many Northwestern Mutual agents would even do that. The challenge is you need to figure out the blend of the $10,000 to $15,000 per year. And if I were you, I would be looking more towards a non-direct recognition company, making sure that the blend is, still going to be good on the cash value side. Making sure that you also work with a company that has good ABRs, accelerated benefit riders. If you become critically, chronically, or terminally ill, that you have access to the death benefit while you're alive in retirement. And Northwestern's living benefits on that level are not up to par with a lot of the other carriers. And that part is what it is. Now, you're not going to get hurt buying a Northwestern Mutual policy. I will say that. At the same time, like if I were you and I were looking to put that much money, I think the story behind Northwestern Mutual and how they always say they're the biggest because they have the largest general fund and they're the largest insurance company and all that stuff. I just look at it as like, that's like one of the most overplayed positionings in the entire world of personal finance and financial companies. They're a good company. Don't get me wrong. From a company solvency perspective and stability perspective and whatever, they're a great company. They're fine. Culturally, I'm not a fan of Northwestern Mutual. They're a little too cliquish. They're a little too cultish, if you will. It's like they really train people and beat their chest on why they're the only company that you should ever work with. And the reality is there's a lot of really good companies and no company can do everything right. That's why we choose to be independent and utilize 5 or 6 different whole life companies to look at based on scenarios. And I can tell you right now, based on front loading policies, Northwestern Mutual is not in the top 5 when it comes to front loading a policy and getting long-term performance and all the benefits that you want to go along with the policy, right? So I don't know if that helps or not, but anybody that's interested, if you're if you want to have a conversation with somebody on the team, anybody can use the link that I just posted there. You can go down and just life180.com/clarity-call. And, it's designed to give you clarity. It's designed to not be a sales conversation. It's designed to like really just answer your questions, help you dial through all the noise around the life insurance stuff, around whole life term insurance, anything you have to do with any of this cash flow investing stuff. It's all the only people you will talk to when you use that link is somebody that I've vetted and they're a certified Life 180 agent that I know will take care of you really well and that will honor the process, so to speak, and just really focus on educating you. And that's that. So anybody wants to do that, feel free to look it over and set up a call, and we're happy to help. But Brandon, awesome, man. Yeah, thanks, man. I appreciate it. I know we see a lot of this stuff through the same lens, and it's awesome. And Asai, hopefully I said your name right, Asai. Good stuff. Thank you. The non-direct piece is something that really helps make sense. All right, cool. So yeah, and Asai, if you have any questions, just reach out. I put the link up there. No harm, no foul if you don't want to use it. But if you do, we're here to help. So yeah, any other questions as this is all coming together on the term insurance versus the whole life insurance versus, all the other stuff that I kind of went down the rabbit hole on. I know we're getting near an hour now. I just want to make sure everybody, that's here is not walking away with any questions or anything of that nature. I will give it a couple seconds and then I'm going to bounce. I think my son is going to be home soon. My wife is taking my daughters to the Nutcracker tonight in downtown Phoenix. And so they're going to that event, which is pretty cool. They do it every single year. And so this is a night that I get to hang out with my son. We're packing a bunch of stuff tonight. I'm going to take him out to dinner. And then we are literally going to be going through all this stuff. If you haven't caught up to speed with what I have going on, we just launched a private equity fund. We're raising money. We're buying a hotel in the Dominican Republic. And I'm going to be spending the majority of my time next year in the Dominican Republic, operating this hotel and running it and getting the investment up to speed. And so my 3 kids are moving down into this little fishing village with us in the Dominican Republic. And we're selling everything. And so it's a very interesting process of minimalism. I don't know if anybody here has ever experienced this, but my wife and I have 22 years of building up all this stuff together. And we just kind of prayed about it. And we've been working through this process and we decided that we needed to purge everything. And we know we're coming back, but we just decided this was the opportunity and it was put on our hearts. We felt like God kind of just put this on us that it was our time to just like have a cleanse and have a purge of all the physical things that we have. I'm selling my Jeep. I just listed my Jeep for sale literally 2 hours ago, which is kind of crazy to think about. It's nuts for me to be selling my Jeep, but I can't bring it down to the DR and I don't want it just sitting around. And so this process has been amazing of just like going the minimalist route. I'm literally cleaning out everything. I'm going to be like so positively in a cash flow perspective that we've never experienced. And it is so freeing. I would encourage everybody that's ever looking at taking a big leap like that to just go do it. But the interesting part where I was going with this is that my 3 kids, they've known nothing in life except for like living on the golf course and, whatever, in this cul-de-sac and having their own little bubble, and they always get what they want and whatever. And so now we're moving to this third world village, effectively developing nation village down in the Dominican. It's a fishing village that didn't even have electricity until a decade ago. And so we're going to be living there, for the majority of the time, kind of coming back and forth, but we're going to be spending a lot of time there. And we're forcing them to get rid of 98% of what they have. They each get to keep a box of stuff. Outside of that box, it's gone. And so tonight I get to go through it with my son, and we're going to be choosing what he wants to keep. And so pray for me because I'm going to need it because it's not going to be easy. But yeah, it's going to be fun. I think it's going to be fun. It's going to be hard. But sometimes it's the hard things in life that are the most fun. So I'm excited. And we leave December 31st to go down there. So anybody ever wants to come down to the DR and visit, you can hit me up, just chris@life180.com, and you can come down and visit, and I'll give you a deal on a stay down there. It'll be fun, but we'll be down there. I got a new studio. If you see all this, my whole YouTube studio, we are completely changing everything. I've literally am building a new YouTube studio down there, and everything, the whole look, the whole vibe, the whole presentation is going to get elevated. I'm so excited about what we have going for 2024 and how Life 180, our agency, the content, the interviews, everything we're going to be doing is going to be hitting a completely new level from a content perspective. So I'm really excited to share that with everybody. So anyway. All right, well, that's it for now. I'm done sharing my story. Hopefully you guys found it a little bit valuable. Reach out if you need anything. You can either go to life180.com/clarity-call. I put the link above, or you could just email me, chris@life180.com. And that's it for now. Have a blessed, inspirational day. Talk